With the holidays coming up and all, it seems like everyone's thinking about like their financial goals for the new year, right? And you know what always comes along with that? Risk.
Oh, yeah. It's something everyone wants, those higher returns. But like, how much risk are we actually okay with to get there? That's the big question, isn't it?
It is. And that's kind of what we're diving into today. We've got this excerpt from a financial newsletter all about risk assessment for investors. It's got some good stuff in there. We're going to break it down, try to make this whole risk thing a little less,
Yeah,
mysterious.
justify it a bit. Yeah,
Yeah.
makes sense. Risk is, well, it's one of those things that's, I think, often misunderstood, but it's like super fundamental when it comes to investing, right?
For sure. So, okay, let's just start with like the basics. I think we all want those higher returns on our investments, right? But the question is, like, how much risk are we really comfortable taking to get there? That's what this newsletter is all about.
Exactly. And it all starts with understanding like the core relationship between risk and return. The basic idea, right, is that investors are basically rewarded for taking on more risk. If something has a higher chance of failing, people need a reason to, put their money in.
Makes sense.
And that reason, that incentive, is the possibility of a bigger payoff if it actually works out.
Okay, so it's like a trade-off, right?
Yeah.
Higher potential rewards, but also potentially higher downsides.
Yeah, exactly. And that's where it gets, interesting because the right amount of risk for, say, you versus me, it's different. It depends on a few things.
Like what kinds of things?
Well, one of the biggest is your what they call a time horizon. How long are you investing for? They use this great example in the newsletter. Imagine you're saving for a down payment on a house. You need that money in like 5 years. That's a pretty short time horizon,
Yeah,
right?
for sure.
Now imagine you're investing for retirement, which is, decades away. That's a long time horizon. And that difference, that time frame, it makes a huge difference in how much risk you can actually afford to take.
So if you need that money like reliably in a few years, you can't really be gambling on those super risky investments, right?
Yeah.
Even if they like could have huge returns.
Precisely, because what if the market just tanks right before you need that cash? You'd
Right.
be you'd be in trouble. But if you've got, decades until retirement, you have way more time to recover if things go south.
Right. So more time to ride out those like market dips and hopefully still see the growth over the long term.
Exactly. It's like almost like knowing that time horizon is the first step to figuring out like your own risk comfort zone.
You risk comfort zone. I like that. So okay, time horizon. What else should we be thinking about when it comes to, assessing our risk?
So beyond just time, there are three kind of key factors. The newsletter calls them risk required, risk capacity, and risk tolerance.
Okay, let's break those down. What exactly is risk required?
Think of it like this. It's the amount of risk you actually need to take to hit your financial goals, whatever those are. If you need your money to like grow super fast, you got to take on more risk.
So it's less about like feelings and more about the actual numbers, right?
Exactly. It's all about the math behind reaching your goals. Now, risk capacity is a bit different. It's about your ability to take risks without like messing up your entire financial situation.
So let's say someone is like already financially secure. They've got a good retirement fund, whatever. They've got more capacity to like take risks with other investments
Yeah.
because they have more of a safety net.
That's a perfect example. And then lastly, we have risk tolerance. This is probably the most subjective of the three. It's all about your comfort level with risk. Can you handle those big market swings without like freaking out and making bad decisions?
Yeah, can you stomach the roller coaster?
Exactly. And some people, they're just naturally more comfortable with that kind of volatility than others.
Oh yeah, the newsletter had this funny analogy for that.
Yeah, the one with the tick.
Yeah, they compared it to like someone who goes completely overboard with tick prevention. Like one tick in the yard and suddenly they're ripping out their entire lawn and replacing it with like tick-proof mulch, practically duct taping their kids to the couch so they don't get another bite.
Right. It's like someone with low risk tolerance might see a little market dip and boom, they sell everything, lock in those losses. But someone with high risk tolerance, they can just kind of ride it out.
So these three things, risk required, capacity, and tolerance, they all kind of work together to figure out your overall risk profile.
Yeah, precisely. And understanding that, your own risk profile, that's key to making good investment choices, right?
Okay, so we've got the basics down, risk and return, those three factors. But how does this actually like play out when you're building an investment portfolio? How do you put it all together?
Well, that's where it gets really interesting. The newsletter, it actually gives a few examples of like classic portfolio types
Yeah.
based on different risk levels. Really helps to see how it all, works in practice.
Perfect. So let's dive into those examples and see how these risk factors actually like shape those portfolios.
Sounds good. Let's start with a low risk portfolio and we'll work our way up.
Okay, so the newsletter has these like classic portfolio types, right? And it's cool to see how they kind of match up with different risk levels. They start with like a low risk portfolio, which I'm guessing would be for someone with, low risk tolerance.
Yeah, that's right. A low risk portfolio, it's all about stability, preserving your capital. Think of someone maybe nearing retirement, like I don't know, a 60-year-old. They want to protect their savings, maybe generate some income, but they don't need huge growth anymore and big market swings. Those would keep them up at night, right?
Makes sense. So what would this kind of portfolio actually look like? What kind of investments are we talking about?
So the newsletter suggests that for a low risk portfolio, you might have, say, 30% to 40% in equities.
Okay, and just a reminder for me, equities are like stocks,
Right.
owning little pieces of companies.
Yeah, exactly. And because stocks can be pretty volatile, a low risk portfolio keeps that percentage, relatively low. The rest would be in more conservative stuff like bonds. Those are essentially loans to governments or corporations.
Right, so bonds are generally seen as like less risky than stocks.
Yeah, they are. They're more about stability, predictable income, which is exactly what someone with low risk tolerance is looking for.
Got it. So less risk, less potential for those like big gains, but also less chance of those big losses.
Exactly. It's about, finding that balance. Now let's bump it up a little. The newsletter talks about a medium risk portfolio. This one's interesting because it kind of fits a wider range of
Okay,
investors.
cool.
Well, think someone maybe in their 30s or 40s saving for retirement, but still has a ways to go, right? A couple decades. They have more time to recover if the market dips, so they can handle a bit more risk.
So their risk capacity is higher, and they might also need their money to grow faster to hit those retirement goals.
Mm.
So their risk required is higher too.
Exactly. And their risk tolerance, it might be, moderate. They're okay with some ups and downs, but not those huge swings.
Okay, so how does that actually like play out in the mix of investments? What does a medium risk portfolio actually have in it?
So for this type, the newsletter says maybe 50% to 65% in equities.
More stocks than the low risk one,
Yeah.
which makes sense, right? Given they can handle a bit more of that roller coaster.
Yeah, and the rest would still be in those more stable investments like bonds, provide some balance, helps cushion things a bit.
Okay, so we've gone from low risk to medium risk. What about those investors who are like totally comfortable with risk? Maybe even, I don't know, thrill seekers when it comes to their money. What does a high risk portfolio look like?
That's where things get, that's where it gets really interesting. A high-risk portfolio, it's built for maximum growth potential, even if it means, accepting that there's a higher chance you could lose money along the way.
So this is for someone who's not just like okay with market swings, but actually embraces them.
Yeah, exactly. Think of like a younger investor, maybe in their 20s. They've got a long time horizon. They're not afraid of volatility. They're all about maximizing returns in the long run, even if there are some bumps along the way.
So high risk tolerance, their risk capacity might be higher too because they have more time to recover, and their risk required could be high if they've got like really ambitious financial goals.
You got it. And in a high-risk portfolio, you're looking at, the newsletter suggests at least 75% equities.
Wow, that's a lot in stocks.
It is. And they might even go for like more aggressive types of stocks. Stuff like emerging markets or smaller companies. Higher potential for growth, but also higher risk.
Okay, so we've covered the main portfolio types, right? Low, medium, high risk. But I feel like in real life, most people don't fit perfectly into these categories.
Yeah, you're right. These are just starting points, right?
Yeah.
Examples of how those three risk factors we talked about, the required, capacity, tolerance, how they can shape your choices.
So how does someone actually figure out like their unique risk profile?
Well, that's where a financial advisor can be super helpful. They can, really look at your situation, your goals, and help you create a portfolio that actually makes sense for you.
Okay. Yeah, that makes sense. Because even with all this info, it can still feel kind of overwhelming to like figure it out all on your own.
Oh, for sure. And there's another thing the newsletter brought up that's, it's something a lot of investors get wrong, trying to time the market.
Oh, yeah, that sounds like a recipe for disaster.
It often is. Trying to, predict when the market's going to go up or down, it's tough, even for the pros.
It's like trying to catch a falling knife, right?
Exactly. And the newsletter, they had a great example of this. Remember back in 2021 when the stock market like exploded,
Or
tons of people saw those gains and like just piled into stocks, figured the good times would last forever. Then when things turned in 2022, a lot of folks panicked and sold everything.
oof, so they bought high and sold low? The exact opposite of what you're supposed to do.
Yep. And they probably missed out on the rebound that happened after because, they let their emotions take over.
So what's the alternative? If trying to time the market is bad, what should investors do?
Stick to the plan. Once you've figured out your risk profile, built a portfolio that, matches your goals, the best thing to do is usually just stay the course.
So don't freak out and sell when the market dips, and don't go crazy buying when it's doing well.
Exactly. Of course, you might need to tweak things as you go, right? Life changes, goals change.
Yeah, like if you get a big raise or inherit some money, you might want to reassess. Or if you're like getting close to retirement, maybe shift to a more conservative approach.
Exactly. It's all about being, adaptable, making informed decisions that, help you in the long run.
Okay, so we've talked about like a lot. Risk and return, the different risk factors, portfolio types, and the whole market timing thing.
Yeah. And I think the key takeaway here is that understanding your own risk profile, that's essential. It's a foundation of a good investment strategy.
Couldn't have said it better myself. We'll be back in just a sec to wrap up this deep dive into risk and investing. Talk about some key things for you to, keep in mind. We're back.
This deep dive into risk and investing, it's really got me thinking about my own finances in a whole new way.
I think that's great. It's one of those things people don't always want to think about, risk, but it's so important. It is. And one thing that really hit home for me from this newsletter is that there's no one right answer for everyone. There's no magic formula when it comes to investing.
Right, you got to find what works for you, your situation, your goals, your comfort level with all that risk. That's why this whole risk profile thing is so important to figure out.
Absolutely. And it made me realize risk isn't just about how much money you could lose. It's about how that would make you feel. That whole emotional side of investing. I hadn't really thought about that before.
Yeah, that's huge because if you're not comfortable with the level of risk, you're more likely to panic and make a bad decision when the market gets, crazy. And that can really mess things up long term.
So thinking back to those portfolio examples, the low risk, medium risk, high risk, are those more like just examples, not
Yeah,
like strict rules?
definitely just examples, starting points,
Yeah.
to show how different risk profiles might lead to different strategies.
So someone's actual portfolio, it could be like a totally unique mix based on what they need and, what they're aiming for.
Exactly. And that's, another place where a financial advisor can be a big help. They can help you build that custom mix.
Okay, that makes sense. So as we wrap up, any key takeaways you want to leave our listeners with, things they should remember?
I'd say the biggest thing, remember that understanding your own risk profile, that's crucial. It's not about picking the coolest sounding investments or, the ones that promise the most money. It's about making sure your investments fit your overall plan, your comfort level.
That's great advice. And I think for me, another takeaway is just the importance of a long-term mindset, not getting caught up in those short-term ups and downs. The newsletter really drove that home, especially with the whole market timing example.
Oh, yeah. It's a marathon, not a sprint. Slow and steady, not trying to get rich quick.
Right. And that means, knowing that there will be dips, there will be times when the market freaks out.
That's where that risk tolerance comes in. If you know you can't handle those big drops, you got to build a portfolio that reflects that.
This has been really insightful. I feel like I have a much better grasp on this whole risk thing now,
Oh,
more confident about making good decisions going forward.
that's awesome. And remember, it's a journey, right? Investing. Always learning, adapting, staying informed.
So true. Well, to everyone listening, I hope this deep dive has been helpful for you too. Remember, knowledge is power, especially with your finances. So keep learning, keep exploring, and keep diving deep into the stuff that matters to you.